Assalamualaikum and hi everyone. I am Madam Yusna Liza. Welcome back to Chapter 6. Chapter 6 is the chapter that we'll discuss on measurement, and this is under Conceptual Framework for Financial Reporting. Measurement is very important because the elements that are recognized in the financial statements are quantified in monetary terms. Measurement is a process of determining the monetary amounts at which the elements of the financial statements, as we have discussed earlier, are to be recognized. Measurement also will answer a question of how much an entity allocates to amount recognized as element in the financial statement. Measurement bases under the conceptual framework consist of historical costs and current value. And under historical costs and also current value, it both provides monetary information about assets, liabilities, and related income and expenses. That is the similarity. However, under historical costs, it provides information derived from the transaction price or other event that gave rise to them. However, this does not reflect the changes in values. As a cliche example, historical cost reflects depreciation and impairment. Under current value, it provides information updated to reflect condition at the measurement date. And this also reflects changes. The current value will reflect changes in values. What are the current value versus what are the values in the previous year or at a previous date. And thus, it also will reflect the estimates of the cash flows and other factors deemed necessary by the company. Under current value measurement basis, there are three options. The first one is fair value. I think most of you are familiar with the term fair value. The second one is current costs. And the last one is value in use for asset and fulfillment value for liabilities. Let's start with historical costs, which is the first measurement basis under measurement basis. Historical cost measurement basis. Historical cost is an entry value measurement basis because it will be looking into historical costs for asset, and we'll also be looking at what is historical cost for asset. So when you first acquired the asset, let's say it was 5 years ago, that is the price that you paid. The price that you paid, let's say 10 years ago, it is what you call historical costs of an asset. When you acquired or created the asset, the value of the cost incurred in acquiring or creating the asset is what you call historical costs. And this comprises of the consideration paid to acquire or create the asset plus other transaction costs. Historical cost for liability is discussed in another separate statement. Historical cost of a liability is when the liability is incurred. Let's say you took a loan 5 years ago. The value of the consideration received 5 years ago that you have to incur or take on the together with the liability minus the transaction cost is the historical cost for liability. So whatever consideration received in order for you to incur or take on the liability minus the transaction cost. So for both historical cost for asset and historical cost for liability, they are both derived from transaction price. Let us look at current value measurement basis. Under the conceptual framework earlier, there were three measurement bases. There were actually two, only that the current value measurement basis consists of three options. And I'm now focusing on the first option, that is the fair value. Under the conceptual framework, fair value is the price that would be received to sell an asset. If let's say you are going to sell the asset today, what is the value of the asset today? The value of the asset today if you decide to sell the asset that you bought 10 years ago, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So it will reflect the perspective of market participants, and thus it is a market-based measure to which the entity has access to. So market price is available actively in certain cases. The asset and liability is measured using same assumption that market participant would use when pricing asset or liability, if those market participants act in their economic best interest. As I mentioned just now, fair value can be determined directly. You can determine it directly or by observing prices in an active market. And it is better for assessing this measurement, which is fair value, is better for assessing future cash flow prospects. So under current value, the first option is the fair value. Let us look at, this is also known as exit value. Exit value because the point is it reflects market participant assumption. The current value. The second one under the current value is value in use. This should be number 1. Let me just correct this for you. And that should be number 2. The next one is number 2. So this is number 1. Okay. Let's just look at it. Now, okay. The second one is fulfillment value, which is for the liabilities. And the value in use, or in short VIU, value in use, is the present value of the cash flow or other economic benefits the entity expects to derive from the use of an asset or from its ultimate disposal. Whereas under fulfillment value, that is the present value of the cash or other economic resource that an entity expects to be obliged to transfer as it fulfills a liability. Those amount of cash or other economic resources include not only the amounts to be transferred to the liability counterparty or to the, if we are the one that are taking the loan, let's say we took the loan from the bank, so we are now obliged to transfer as it fulfills a liability, so that is the counterparty, but also the amounts that the entity expects to be obliged to transfer to other parties to enable it to fulfill the liability. And this values which are current value, value in use, and fulfillment value, it reflects entity specific assumption. It is not a market-based assumption. And both are also exit value. We'll go into that in a short while. Now we go to the next one, which is current costs. Current costs of an asset, we start by looking at current cost of an asset. Is the cost of an equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date plus the transaction cost that would be incurred at that date. Let's say 10 years ago you bought an equipment that cost you perhaps 1 million. What is the value of the same equipment, new equipment, if you are to buy that same particular equipment today? So that value today is what you call current cost. The value 10 years ago when you first acquired that particular equipment, it was the historical cost. But if you are to buy the same asset, which is a new asset, today, that value is the current cost. So therefore, that is also the same case for the liability. So the current cost of a liability is the consideration that would be received for an equivalent liability at the measurement date minus the transaction cost that would be incurred at that date. Let's say today, for example. And current cost also reflects entry value. Entry value is actually reflecting prices in the market in which the entity would acquire the asset or would incur the liability. Under current costs itself, what should be also clarified here is that current costs are just like a historical cost. It is an entry value. It is the one that will reflect prices in the market in which the entity would acquire the asset or would incur the liability. So the price 10 years ago and the price today of the same asset, for example. That is the entry value, the value when you are acquiring the asset. That's why it says entry. Next, however, that is different from fair value, value in use, and fulfillment value. They are exit value. For example, if you have the asset and you decided to sell the asset that you bought 10 years ago today, that equipment that you bought 10 years ago, the value today might have dropped due to a depreciation factor or maybe due to some impairment loss that had taken place much earlier. So that drop in value would have caused the value of the asset or the what you call exit value to be either the fair value, where we say fair value here is related to the disposal, for example, just now. So that is going to be the fair value, and it is called the exit value. When you dispose, how much is what you get. So the price that you expect to receive from selling that equipment, therefore, that is the fair value. And that can decline or can also appreciate. That appreciation normally happens for item like land. However, unlike historical costs, current costs reflects condition at the measurement date. So current costs will reflect the condition at the measurement date. Now we go to the next one, which is the last few parts of the chapter 6, which is the factors to consider when selecting a measurement basis. Conceptual framework gives some guideline. However, the factors that are listed in the conceptual framework, the relative factors, depends on facts and circumstances. It is necessary for a company or reporting entity to consider the nature of the information as well as other factors when they select or choose the measurement basis for the recognition of asset which is later being measured. First, you recognize, and then you need to measure how much is the amount that you have recognized for asset and liabilities. And these factors will lead to consider the relevance characteristic or the fundamental characteristic of relevance. The relevance or the how relevant is the information. You can check the detail in the paragraph 6.49 of the framework. The characteristic of that asset or liability, you can have that detail in the paragraph which I mentioned. I'm going very briefly here. The contribution to the future cash flows, the pattern of contribution, for example, the uncertainty of it, or perhaps the variation of that will contribute to the future cash flow. You go detail in the chapter itself. The faithful representation, whether or not it represent whatever it purports to represent. It is actually without bias. That is also one of the important criteria. Faithful representation. Enhancing qualitative characteristic together with the cost constraint, whether the benefits still outweigh the costs incurred to provide that information or to use the measurement basis. What are the enhancing qualitative characteristics that can support further the faithful representation and relevance? Historical cost itself as the measurement basis. You need to also consider, is that the appropriate measure, and also the current value either current value, you use current cost, you use value in use or fulfillment value, or fair value. Next, the framework also, the chapter 6 also discuss on measurement of equity, but it starts with, it says there that it is not measured directly. The carrying amount of equity is not measured directly. It is actually equals the total carrying amount of recognized asset minus recognized liabilities. Asset minus liability equals equity. So equity is actually as a result of the whatever you have recognized as an asset and how much is it, as well as whatever you recognize as a liability and how much is that liability. The difference or the residual interest, as the term used, is what you call equity. How much is depending on assets and liabilities that had earlier been measured. And according to the conceptual framework, it may be appropriate to measure directly the carrying amount of some individual classes of equity and some components of equity. For details, you can refer paragraph 4.65 of the framework. The total carrying amount of an individual class of equity or component of equity is normally positive, but it can also be negative. So like profit, right? If there is an element of equity, the profit for the year, the net profit, it can also be negative, but you will call it net loss. It can also be positive. Of course, most of the time you want to see the profitability of the company keep rising. The next one is that total equity is generally positive, but it can also be negative, depending on which assets and liabilities are recognized and how they are measured. And the last bit of the chapter 6 is on cash flow based measurement techniques. That is in paragraph 6.91 up till 6.95. And according to the relevant paragraph there, such techniques, which is the cash flow measurement techniques, they are not measurement basis. However, these are the technique being used to apply the measurement basis when using such a technique. It is necessary to identify, if you use the cash flow based measurement techniques, you need to identify which measurement basis is used and the extent to which the techniques reflects the factors applicable to that measurement basis. And I only put a few of the paragraph here. If you want to see the detail, you may go and check the detail. And outcome, it will also give rise to outcome uncertainty. Remember, this was actually discussed under faithful representation and also relevance when we discuss the chapter qualitative characteristic, which arise from uncertainty about the amount or timing of future cash flows. You can also check paragraph 6.61a. And when you measure an asset or liability by reference to the estimates of uncertain cash flows, one factor to consider is the possible variation. This is the variation that would cause the cash flows to be uncertain in the estimated amount as well as the timing of those cash flows. You can check paragraph 6.14b of the document Conceptual Framework for Financial Reporting. That's it. That is the end of chapter 6. That is the end of chapter 6. And it looks like you are ready for chapter 7. Before we start with chapter 7, let me just tell you that you can always pause this slide. You can always slow down the playback speed and go and rewatch them. You can rewatch the first until chapter 6 and just do it at your own pace. With that, I thank you for watching. I'll see you when I will see you. And until I see you again, bye-bye and Assalamu alaikum.